Student housing is such a unique industry. The more unique an industry is, the more important it is for that industry to have a resource and a platform to share ideas and data, to determine best practices, and a platform to simply promote networking among the professionals in that industry. That's what we are setting out to provide with Student Housing Insight. But what's even more unique about the student housing industry is how unique those professionals are. They want to make a positive impact on the students and the university communities they serve. They understand they have an opportunity to touch the future. They come to work every day looking for ways to make that future bright. If you're one of those people, come be a part of Student Housing Insight. Well, what's up, everyone? Welcome to ShopTalk for October 2025. Hope everyone's doing well. Would love to see some comments in the comment section. Let me know that you can hear me, and would love to know where you're watching from today. A couple of housekeeping things. Number one, I'm your host for today. I'm Wesley Dees, CEO of Student Housing Insight. If you don't know anything about Student Housing Insight, not only are we the host of this, but we also produce a podcast for the industry, as well as a lot of other content and events. We are a platform for student housing professionals to network, to share data and ideas. So if you want more information about that, you can go to studenthousinginsight.com. A couple of housekeeping things I want to just go over really quick. If you will, want you to be active in the chat. This is a very interactive. Let me change my screen up here a little bit. We want this to be a very interactive webinar. So if you've got questions or comments, we encourage you to put that in the comment section. You will see that should be over on the right-hand side if you're looking at a web browser. If you're looking from your phone, I believe it's below the video. So just put those comments there. Also, if you've got questions for myself or for the panelists, do me a favor and just put a Q in front of your question. That way my producer Jan can star that and bring that up for us. I want to give you a quick recap or a quick forecast of what today's agenda is. We do not have a policy and legislative update from NMHC, but we will be talking about the NMHC conferences coming up and our upcoming industry events. We've also got a topic of the month. We're going to be speaking to some operators and finance and investment folks to try to get a little bit of an outlook as to what they're seeing kind of come together for fourth quarter and first quarter of 2026. And then we've got our 2026 national and regional pre-leasing update, because we are already at that point. Well, hey, I want to go ahead and jump into industry events, and I've asked somebody to come help me with that. Whitney, how are you?
I'm good, Wes. How are you?
I'm doing fantastic. You were obviously no stranger to Shop Talk. You were with us back in July talking about all things tech and operations. But for those that may not know who Whitney Kidd is, you want to give everybody a quick intro?
Absolutely. Hey, everybody. Pleased to be with you all today, and thanks for joining. As Wes mentioned, I'm Whitney Kidd, and I have the pleasure of serving as SVP of Innovation and Technology at the Price Company. At Price, of course, we're a student housing operator, but we also have a full innovation engine where we're testing new technologies and figuring out what is working in our industry and what's actually moving the needle. So really pleased to be here today to talk about some upcoming events.
Well, hey, the first thing that's coming up in just a couple of weeks, not even a couple of weeks, we're all going to be in Scottsdale for the National Multi-Housing Council Annual Student Housing Conference. That's coming up the 20th through the 22nd. Jan will put some info in the chat regarding a link for folks to go register or get more information if they're not already registered for that. But I wanted to specifically bring you on because you are also part of the W.Collective, and you guys are doing something on Tuesday at the conference, and was hoping you could tell us a little bit about that.
Absolutely. So we're very excited. The W.Collective, which if you're not familiar with the W.Collective, was founded by all executives within the student housing industry to empower women and also to connect our allies as well. This is not just a women's network. This is a network across our entire industry. And this year, NMHC has decided to partner with us specifically. So they'll be hosting an event on our behalf at NMHC Student. As you can see, that's going to take place Tuesday, October 21st from 12:15 to 1:45. It is open to all NMHC student attendees, so we really hope that you join. I know my whole team will be in attendance as well as others, which is incredibly exciting. And we will be having our entire board that's present at that conference, as well as some really great stories and a good time to just network with our peers. I'll say, Wes, I'm always proud of being in student housing because we have such great initiatives. We have the W.Collective, we have Hi, How Are You? Multifamily, when I'm at other conferences, really are looking to us in student housing to how to move the entire industry forward in a really great way. So very proud that the W.Collective and NMHC have this partnership and that we are able to have a great luncheon to bring everybody together at this particular conference and see how we can continue this momentum.
Well, fantastic. If you were watching the countdown video, you also saw an event that we're hosting on Tuesday night, which is our now third annual Top Golf Mixer at NMHC. So if you're an owner, operator, or developer, you are invited to that. We're also doing at the event a silent auction to benefit the How Are You project and the College Student Mental Wellness Advocacy Coalition as well. So if you fit into one of those groups of either working for or being an owner, operator, or developer, we will put a link in the chat for you to register for that, RSVP for that if you haven't already. So if that wasn't enough, we've also got OpTech coming up next month in Las Vegas. A little bit something different. You've talked about this before. It's has been part of the not webinar, but the event series that NMHC does that they put on each year, but a little bit different. It's actually being, I guess, produced by RETTC. You've given us a little bit of a background on RETTC previously, so maybe you could talk about that and maybe a little bit about OpTech as well.
Yes. So another exciting conference that we have coming up. If you're not familiar with RETTC, it is the Real Estate Technology Transformation Committee. And NMHC put RETTC together because typically NMHC will lobby for housing, as we all know, which is incredibly important. But as we've seen in past years, there's a real need to lobby around the technology that powers our industry. And so that's the goal of RETTC, so that we can help educate our legislators, as well as our industry on what are best practices and how are we using technology to make sure that housing is affordable and accessible for all. And so as a note, there is a shift this year. If you've attended OpTech in the past, you do need to be a member of RETTC, but you can reach out to NMHC or go to the RETTC website to find all of that information to be able to attend OpTech this year. And all of those proceeds, again, are going to empowering our industry and making sure that we're protecting and educating around the technology that we use day to day to make sure that we can operate efficiently and serve our residents in the best way possible. So some exciting things coming at OpTech this year. We will have keynotes from Airbnb, as well as many other great speakers. Also, if you know me, we are very much in the robotics space. We will have several robotics applications.
Is Donna going to be there? Is Donna going to be at OpTech?
Donna 2.0 is going to be at OpTech. You can meet her personally if you've not already. She will be very much present in every area there.
Have you figured out the battery on the airplane thing? Because I didn't get to, Donna was there, but only in spirit, I guess.
In body and not battery.
In body and not battery at interface.
We've thankfully figured it out. We've also gotten great friends in Vegas that have allowed us to keep batteries in Vegas because Donna 2.0, our humanoid robot, is there quite a bit this year. So we have got it all ironed out. She's already been to Vegas twice since you met her last in Austin, which is exciting.
Great.
Yeah, one final note, we will be having also the AI Town Hall at OpTech this year. And that is a framework we've put together for our legislators, as well as us as an industry, of how we need to navigate AI moving forward and how we can make sure our industry is protected with AI utilization, So that's going to be on the last day. Just highly recommend attendance this year. As much as technology is infused in everything that we do, there's a lot of great things coming out with RETTC and OpTech to be able to make sure our industry is well informed and empowering and innovating to the future.
Oh, great. Well, there's one more event that I want to talk about. If you want to stay on, I'm also going to bring up Randy. He's on our next segment, but I'll go ahead and bring him up now. Randy, how are you?
I'm good. How are you?
I'm doing great. I figured since we had you here, we would, as we talk about LeaseCon, TurnCon, might be a good opportunity for you maybe to say a couple of things. But 7th annual LeaseCon, TurnCon, this is the event for professionals in our industry that are, really focused in on not just leasing and marketing, but also, that either oversee or have some kind of hand in the turn process each summer. It's going to be in Charlotte again this year, December 8th and 9th. Do you have anything you want to add to that?
You've got the basics down. I would just say that if you are up and growing in your career, it's a great place to be, and it's a great opportunity to learn more about the operations side of the business.
And again, that's December 8th and 9th. I know we had your counterpart from Interface, Rich Kelly, on last month to talk about it. And as far as registration is fully open, I do believe you guys are doing some group rates. Is it
Yep.
if companies bring 4 or more?
You get a discount if you bring 4 or more people.
Perfect. I also want to bring up, Student Housing Insight is providing 3 scholarships for LeaseCon, TurnCon, because we do understand that, especially if you're at the property level, and Randy, I would say this is really property manager level all the way up to certainly regional manager, even SVP of ops, COO.
It comes down to the operations side. I always say the operations and leasing side.
Yeah. So we understand site level, regional level, it's hard to put continuing ed stuff into budgets. So we're working with our sponsors to actually provide 3 scholarships for LeaseCon, TurnCon this year. And it's not just, the registration fees. It's also going to include round trip airfare, or a $500 Visa gift card if you're driving, as well as a 2-night stay, up to a 2-night stay at the Uptown Charlotte, which is the conference venue. So you can scan that QR code. Jan will also put something in the chat. And this isn't just, maybe you can't go, but you want to nominate a colleague to go, you can do that as well. So just go to our website, and it's the top banner on our homepage, but we'll also put that link in the notes. Well, Whitney, thanks so much. I'm looking forward to seeing you in Scottsdale in a couple of weeks. And I think we're going to move on over and start talking about investment and finance.
Thanks, Wes. Thanks, everybody.
Thanks.
And Wes, I'll add my thank you to you for helping to sponsor that scholarship and your sponsors.
Absolutely. Love that conference. And I'm happy to be a part of it. Guys, now that we've kind of got everything settled with what's happening or what's happened with occupancy, the crystal balls may be a little bit clearer as to what folks are planning on doing as far as, refis, recaps. And Randy, I wanted to invite you into this conversation because at Student Housing Business Magazine, you guys are covering this stuff on a weekly basis. If folks are not subscribed to Student Housing Business, certainly would encourage everybody to go to studenthousingbusiness.com and subscribe there. But our leadership committee wanted to bring some folks on that, live in this world that can, kind of tell us what the next 6 months, maybe longer, are looking like. So with that said, we had a great prelim call on Monday. I'm looking forward to what everybody is going to share with us, but I'll turn it over to you, Randy.
Thanks. We're going to kind of straddle the line between finance and investment, which is a little bit, it gets a little intertwined as we underwrite properties. So to start off with, everybody knows that there was a interest rate cut in September. That's exciting for the industry because it means that properties get a little bit more affordable. And then while that was anticipated a little bit, and further cuts are further anticipated, they're somewhat baked into the forecast this year. Has it had an immediate effect on investment sales activity or underwriting? Justin Glasgow, I'm going to let you take that over first.
Well, really quick, Randy,
Yeah.
before we go to that first question, let's do a quick intro for everybody.
sorry.
If Justin wants to. wants to start out, and then we'll come back to that question.
All right.
Yeah, you bet. Yeah. Hey, thanks for having me on. Good to be here. I'm Justin Glasgow, and I run the National Student Housing Group at Northmark.
Brandon.
Hey everyone, thanks for having me as well. Brandon Smith, I'm with Tailwind Group. We're an owner-operator of student housing.
And then Susan.
Hello, everybody. I'm Susan Folkemer. I am with the Price Company, and we are also owner, operator, developers of student housing, located in Raleigh, North Carolina.
All right. Forgive me for jumping the gun.
Yeah.
Justin, do you want to talk
We're
about
eager to.
the interest rates and how that may have
Yeah,
an effect or not?
Yeah, I'll try and tackle that. I mean, yes, that's right. There was a 25 basis point cut to the Fed funds rate in September, I think largely anticipated by the market. There's two elements to that cut, right? There's the floating rate, which is the 1 month term SOFR, which dictates floating rates, and then the fixed rate, which is typically treasuries. And you saw kind of a mixed bag. You know, the floating rate took a few weeks to drop, and it's down 12 or 15 basis points or something like that to right around 4 today. U.S. Treasuries, at least the 10-year, actually moved upward just based on its forward-looking and longer-term approach to the market. So I don't think it really. There were certain borrowers who had with our clients and in our deals that had deals teed up for a refinancing. Some of those folks kind of tried to jump through the window quickly, but I didn't see a ton of activity being driven only by that rate drop. Most of it was normal sort of business plan, or leasing activity, overall valuations, et cetera. So it wasn't driving a ton of that. We're providing BOVs obviously to lots of different owner operators across the country.
Yeah. Susan, and
we update our BOVs according to these rates. It's really it didn't drive pricing all that much. So I from our view, it didn't change a whole lot.
Susan, as an active buyer, are you seeing any more properties come to market?
So I don't think that's driving necessarily yet the properties coming to market. Maybe some other factors that we'll talk about a little bit further in the conversation are going to drive more properties coming to the market. But again, everything that we're seeing and hearing, is the debt markets are flush with cash and everything is super competitive. So everybody's a little excited about that. Lenders could also be, trying to get deals done in anticipation of their, deals that they write now, their notes will be more valuable later. So again, we're just seeing some extremely aggressive activity when we're going out and shopping for debt. Again, with the downward pressure, we'll see how it impacts the activity. But we do, expect that deals will be a little bit easier to pencil, which is always helpful. Lower rates, often are followed by lower cap rates, which is something everybody's anticipating. And again, willing to get more sellers into the market. So we're hopeful that if this activity continues, that we'll see that bid-ask gap narrow and we'll see some more deals come to the market. Again, there are going to be other driving factors as well.
Yeah, great. So there's a lot of properties that are headed for refi, on 5-year or adjustable rates that are up for refi in the next 24 months. There are enough players out there in the market that will be interested in those assets, and what options are available for properties needed to refi. Brandon, you want to talk about that?
Yeah, sure thing. I do think there's going to be a lot of players in the market. I think there's a lot of us, us included, that have been trying to fill the pipeline over the last 90 to 120 days and probably haven't seen as much as we'd like to, both from the institutional side and from the traditional owner operator side. And I know we cover this in a lot of questions. I just think it's a confluence of different factors. It's not all going to be driven by what the interest rate markets do. I think your prior lease up has things to do with it and where certain properties are positioned, what the outlook looks like for 26, 27. But to your specific question, yes, I think there'll be people interested in these assets. And I think in periods of slower investment sales activity, there usually seems to be a ramp up. And, naturally, the summer is typically slow in the student world. Not a lot of transactions happen on or around move-in day and move-out day. And now we just started pre-leasing again. So a lot of people want to get their, 2026 NOI on the books to get out for sale unless they have a very, distressed sale of what their past outcome was. What options are available for refi? We're seeing a lot of good options. We have a few properties out right now, on stabilized deals. Our capital markets team is saying Freddie Mac and Fannie Mae are being aggressive. A lot of the bigger banks in the US are also getting aggressive and competitive. We're seeing spreads come down, leverage going up with a lot of those banks. And then for us, we do a lot on the value add side. We're seeing debt funds get more and more active over the last 6 months, getting really aggressive on leverage. Specifically, we just brought out a recent refinance on a somewhat challenging deal that isn't as stable. And we got 10 different term sheets, all with good pricing, and had a lot of good options there. So I think there's a lot of strong options available for refi, depending on, what the asset is and what the stabilization level is.
Justin, would you like to add on to that?
Yeah, not much to add on the refi component. I mean, I think that's right. There's more money has been raised and is looking to deploy in the space, and it's across the agencies, the national banks, the local and regional banks. We've had some luck with those folks for certain markets where they can get particularly aggressive. We've even had some CMBS quotes. I haven't closed anything there, but so there's definitely a lot of refi options or lenders on the refi option. You also mentioned recaps. One thing I'd say about the recap front, we're seeing that in lieu of sort of a broadly marketed sales process, if you will. Oftentimes people are just taking out a capital partner and the sponsor staying involved. The timing around those makes it a bit easier to do that because they're controlled by the sponsor. So it's not inside of a sales process, if you will. So it's a bit easier. But the one thing that we're hearing this is attributing to it, and it's also making it a bit more difficult for some sponsors, is the focus from capital partners on the sponsorship itself, and in particular, existing partners. We take out a lot of different offerings, and feedback we get from equity partners is often we're really not looking, or it's a very high bar to add a new operating partner and to enter into a joint venture with somebody that we haven't worked with in the past. So I do think there's a bit of focus on that. It's probably around just the operations and where we are in this cycle. But for sure, there's recaps happening in lieu of sort of a broadly marketed sales process.
Great. 2025 has been an okay active year for investment sales properties, but the fourth quarter is when we see a lot of the action. What are we seeing here ahead of NMHC? Susan, are you seeing a lot of properties come to market in terms of right ahead of NMHC? Where are we on the volume now, and what are you forecasting for the rest of the year?
Sure. Again, the brokers, like Justin just said, they say that they're doing a lot of BOVs. And so it's hard to tell exactly what's going to come out at NMHC. We've seen a few things start to pop out here in the last few weeks. But there's been product out all year. It's not been maybe the highest quality product. We've seen a lot of product come out in the tier 2 and tier 3 markets, for example. As Justin just mentioned, again, recaps and off-market deals really have seemed to eaten into the pipeline, the marketed pipeline. And we don't necessarily see that changing. So that does impact the amount of product out. Again, an interesting stat for us, in 2024, we either reviewed through our initial investment review or underwrote approximately 250 deals. In 2025, year to date, that number has been cut in half. So again, that gives you a little bit of a statistic about deals on the market this year. Again, as Brandon just mentioned earlier, Q4 is usually the most active period of time. So with rent rolls baked and maybe some interest rates coming down, maybe that will push some good things out to the market. To again, take advantage of this cycle. And I reiterate the same thing that both Justin and Brandon said. I mean, there's plenty of equity on the sidelines poised right now, but they are going to be looking to partner with really good operators to minimize risk and maximize returns. That's going to be a big focus.
All right, Brandon, what are you seeing?
Yeah, we see the same. Susan and I actually talked about this a few weeks ago. We were together, and quality of product over the last 3 to 6 months, it's been out there, but just nothing that, we're getting too aggressive on and chasing. I hope we see a lot of activity. We're kind of in that awkward phase right now. if you didn't perform on the 25-26 cycle, now you have interest rate relief, potentially coming where, we're looking at a deal right now and they kind of gave us a top line number and said, if we don't hit that, we're comfortable refinancing and resetting business plan. So that could, deter some sales that would have happened last year, would have happened 2 years ago. And then for the stable stuff, and I think we're becoming there's kind of markets that are separating themselves that everyone wants to be in. And I think you're just going to see a lot more recap activity because, us as owner operators, like there's certain markets that why would we want to leave? If we're underwriting another 10 to 15% rent growth for 26, 27, why put it on the market? We just started pre-leasing. They're going to talk about that later. A lot of people are going to want to get some good pre-leasing activity, a pre-lease rent roll on the books. And that's where I think, into Q4 and a lot of the closings probably spill into Q1 of next year, just with the underwriting diligence and closing process. I think we'll see ramped up activity end of Q4 and into Q1.
Great. Justin, you want to let any cats out of the bag beforehand?
Not anything specific, but I look, we've been busy doing a lot of BOVs. Some of that stuff I think is for other purposes than a marketed deal. Could be sort of a check. Sometimes that's and we're happy to do those, but they won't actually come out. I think it's, Susan and Brandon both sort of said it in not so many words, but it's situational, right? There's all sorts of reasons why folks might want to get out of certain deals, and those could be as simple as the underwritten returns are not sort of matching the facts on the ground. It doesn't mean it's a bad deal. It just isn't going to hit the returns that people thought. They might have a maturity. There's all sorts of factors that come into that, and whether those deals are broadly marketed or not, I think depends on is an existing lender willing to work with you if you have maturity? Is it a market that's doing really well and will be easier to recap with a new equity partner and take out an old? So it's hard to predict if you're looking at the entire universe of, it's called institutional student housing, what's going to trade. The sector is so small relative to other property types, and folks know each other well. Those kinds of relationship transactions can often be to sort
Speaking of it, this is a small industry and everybody knows each other, but we have seen a lot of new names in the past 2 years. Are you seeing any of those new names as you go out and bid against properties, or is it the same top 25 owners? What would you say to that, Susan?
Again, I think a lot of the groups that came on post-COVID are still there. Some of them have actually gotten some deals done, maybe not since Q4 24 or Q1 25 even. We're seeing some new smaller groups actually entering into those tier 2 and tier 3 markets and getting some of those deals done, which I think is great. Again, some of the bigger groups are still sniffing around. They tend to be more cautious on their underwriting and assumptions. So it's been harder for them to get deals done, this period of time. But the good news is, listen, we're still seeing, folks at these conferences. We're still having conversations with people. We're still having pipeline calls with existing and potentially new clients. The other real positive thing is obviously that student housing is, the fundamentals are still accretive, right, compared to other asset classes. So we really have a good platform to be able to continue to attract and maintain investment interest.
Brandon?
Yeah, we think that a lot of the new entrants in the space are still interested in the space. And, our team was sharing with me that they've even seen some shift in, more direct focus on student. I think a lot of those new institutional partners that came in post-COVID it was a multifamily investment with an allocated bucket towards student. And now we're even seeing some more fund creation with a direct target for student only. So a more specific investment criteria rather than we're out for however many million and we might throw a few million at a student deal, but it's part of a broader multifamily fund. But again, they're slow, they're cautious. And, I think what you'll hear later in the pre-leasing is, the pre-leasing cycle probably created some more awareness around some volatility in some markets and things like that. So I think they're there. They're going to continue to enter the space, but definitely at their own pace.
And Justin, without revealing any secrets.
Yeah, I mean, all that's right. There are, in my experience and having been involved in the sector for a long time, I think there's more people poking around, if you will, than ever before. The challenge is who's real, who's ready to commit. There's lots of folks interested, and it's all around growth. We student housing, I should say, actually has growth, and there's lots of sectors out there that don't. And there are a few that, data centers, some niche asset classes, but it's not the same level of growth as you might get in conventional apartments. So we're seeing a lot of these sort of crossover investors or student adjacent investors, folks who want to get involved and understand it. Some of them are partnering with operators, some of them are trying it themselves. But I think the sector itself looks attractive because you've got growth, but it's hard to tell exactly who's ready to commit.
Susan and Brandon, you guys have been ready and you have acquired in the past year. Tell me about what is attractive to you property wise, and maybe give me an example or two of what you have acquired.
Sure. Brandon, you want to go first? You want me to?
Go ahead.
Okay. So first, again, our little thesis again for acquisitions, we continue to be focused on tier 1, power 4 markets, for value add, core plus execution, where we implement targeted CapEx program and achieve mid-level team returns, right? So that's kind of down the road. For development, obviously our yield on cost returns has significantly expanded, but we're evaluating actually some new and interesting markets on the development front. Yeah, a little bit about what we've done this year. In 25, we'll finish just under $1 billion in transaction activity. It's a little bit different than 24. I'll give you a quick comparison. We will have capitalized about $225 million in development capitalization. And then about $350 million in recaps this year, and about $425 in dispositions. So comparison to 24, where we finished just under $600 million in transactions. So again, significant increase in transaction activity for 25. But in 24, half of that activity that we did were actually in true acquisitions, and then a smaller number on the recaps and dispositions. So again, it's we're getting transactions done in and out, but again, a little bit different this year than last year. And for us, again, this year, we really focused on kind of 3 prongs, internal recapitalizations, as I just mentioned. And, again, that's where we have successfully executed our business plans. We've achieved those projected returns. We continue to have conviction in those forward-looking markets and that value add proposition. So I know us, like peers in our industry, are focused on that and continue to be. Some of our most exciting acquisitions over the past year, though, have been in disconnected markets, markets where they were significantly soft coming out of COVID. They had very limited or no development activity and saw enrollment growth. So again, those markets haven't had mass development at scale. So we continue to see those markets as an opportunity, both on the acquisition and even disposition side already. And then again, we've seen a significant uptick in fully entitled development sites where other groups haven't been able to get their deals capitalized. And for us, at Price, we're not a merchant developer, but we can bring our expertise and our relationships to the table. And we're very disciplined in our underwriting and very picky at the sites that we do, but we're able to see a good pipeline from that as well.
Great. Brandon?
That's perfect. I had her go first because our thesis is pretty similar. We're definitely in the value add space on the acquisition side. That's what we focus almost all of our attention on. We maybe do a little bit more distressed value add. We're willing to take on highly distressed, low occupancy, negative NOI properties with a little more patient stabilization period. So we've acquired 5 new deals this calendar year. We've actually disposed of 3 with 1 more under contract. So we've had similar volume to 2024, 24 and 25, a little bit higher than 23 for us. It continues to be very attractive for us in the value add space, whether a really hairy project with a lot of work, or there's some in markets that we just really love that it's a lot more targeted capital improvements at smaller dollar amounts, but we're believing in that market over the long term. So yeah, that's what we're continuing to focus on. We haven't done a true ground up development since 2022. It's not really what we do. We always look, but something interesting looked at and actually executed on. We just finished up a project in College Station, is actually taking our current sites and adding units and beds to existing sites that have buildable land and space, or repurpose of, we repurposed a dog park, 2 big tennis courts and a volleyball court into 4 new residential buildings at our property at Texas A&M. So I just consider that like a mega value add, and I still don't call it development because we're already on the site. We know the market, we have our team there, and we're continuing to explore options there as well at some of the markets and properties that we really like.
Great. Well, I know Wes wants to move on to the occupancy and leasing segment. So I want to thank you for joining me today, and thanks for having me, Wes.
Well, thank you, Randy, and thank you to the panel. Really appreciate you guys taking some time out this week to answer those questions that I think is on everyone's mind. And I know all of you guys are going to be at NMHC in Scottsdale, so we'll see you there. And if anybody wants to reach out to you and sell something or list something, all of these guys can be found on LinkedIn. So go there and get them if you don't have their emails. Guys, thanks so much.
Thank you.
Thank you.
Thank you.
All right, guys. Well, let's move on to our pre-leasing segment. We're moving on to fall 26. We are going to talk a little bit about how fall 25 ended up. We do have some more updated numbers than what we had last time, so I felt like it was good to go through and see those. We are missing someone in this regular segment, which is Charlie Matthews from College House. For those that don't know, Charlie's no longer on the market. He got married a couple weeks ago, and he got back and sent me a email on Monday saying he didn't realize how long it would take him to get through his emails after being gone for 2 weeks. So we have given him the day off today from ShopTalk, but I'm going to start going through some slides here in a little bit. But first, I wanted to go ahead and introduce our panel for today. So Christina, we'll start with you.
Okay. Well, hi, everybody. Thank you for having me. I'm excited to join the panel. My name is Christina Poor. I'm actually a recent addition to the UGO US leadership team, and I am their VP of Operations.
Hi, everyone. Brian Shelongoski. I am also a recent change to Be Home Student Living. I am the EVP and COO of Be Home. Glad to be here.
Now, wait a minute. Before we go on to Sydney, I've got to ask you about something. I'm flipping through LinkedIn last week, and all of a sudden I see this come up.
You're going to put me on
I don't want to repost it.
I was impressed by this.
I was extremely impressed. Shoot,
oh, darn, it's not working.
We're posting live.
Watch again. Here we go. Let's blow this up so everybody can see it. This is at the Entrada Summit, Brian?
Yeah, it was. It was a bit of a surprise. I was not surprised that we got called up. I mean, I was a little surprised, but all of a sudden I felt a hand on my back, and there comes Rob Gronkowski coming out and decided to sing karaoke with us.
So how many drinks did it take to...
I was 100% water that night.
I'm even more impressed.
It was very fun.
Sid, I don't know that you've got that. I don't know that you've got anything to follow that up with.
I can't top that one.
Please introduce yourself.
Yeah, I'm Sydney Everett. I'm the Director of Leasing here at GMH Communities. I'm not new to GMH. I've been here just about 4 years, but GMH just celebrated their 40-year anniversary. So we're excited, and I'm excited to be here.
Well, great. Well, hey, I want to go ahead and jump into some numbers. On September 11th, we had our last shop talk, and we had some preliminary numbers. And for those that tuned in to Student Housing Business's webinar with Charlie and College House, going over the final numbers that they finalized on September 15th, there was a little bit of change. I want to start with looking at this regional average pre-lease for the 5 regions that they monitor, as well as nationally. At that point in time, we were just under a percentage year-over-year increase But this is how it ended up by the 15th. We were 0.5% behind year over year. And you can tell there with, if you look at some of the regions, Western and Northeast regions performed probably the best year over year, while the Southwest lost a full 100 basis points on occupancy, and Southeast fell by 20 basis points as well. Just a quick question for the panel here. Really just wanted to, how does this match up with what you observed in the markets that you're operating in? And yeah, let's start with that question.
Yeah, for sure. I think as a general notion, I think we pretty much fell in line with these trends, but actually this group was having a good conversation yesterday in regards to maybe how this played on our expectations with no-shows and how it fared in comparison to previous years. I think maybe another interesting point of context was how it all landed with us with international students, and maybe what that conversation looks like and how they played into maybe a higher uptick in no-shows than we had sort of seen in previous years. But I would say from a general geographical standpoint, we kind of fell in line with the general trend that you've got on the screen.
Yeah,
I would echo that. Go ahead, Cindy.
We've got a lag over here, sorry. No, I would say I would echo what Christina said, and I think what she brought up about the international students is an interesting conversation, because I think in the markets where we expected the most fallout from international students, that was actually some of our markets with the lowest no-show count, which, we had spent all year kind of preparing for that potential, and the story kind of changed there at the end. And some of the markets where maybe we didn't hit this year seem to be the most promising for 26, 27. So I think what Christina brought up about international students, it just wasn't what we were expecting for this year, I think.
Yeah, Wes, I would echo everything that's been said by both Christina and Sydney. The no-show piece in particular was new to us. It was about 100 basis points higher than any historical data that we had shown in prior years. So that was interesting, and we confirmed that data with several other companies in the industry. There was no trend as far as specific markets or unit types or even asset types. It was really just kind of all across the board, dependent on different markets. So that was interesting. And then obviously, rate is everything. Affordability, we hear that term a lot, but it's becoming more and more prevalent. We're seeing the lower rate unit mixes are going a lot faster off the board. And then obviously that means the higher density units and farther from campus are leasing faster for the most part than our sort of A+ right off campus kind of thing.
Gotcha. I'll go through a couple more of these slides. I mean, this is the 5-year trend. So going back to the lease up for 2021, not a lot to talk about here other than this most recent lease up was the least performing. I'm not sure there's a positive way to put that, but it's out of those, and the thing about it, and we talked about this on the prelim call, it seems like it's a real return to kind of 2019. Then we've got here just kind of a breakdown of the floor plans. What is kind of interesting with this, if you watch the September ShopTalk, there was a complete kind of flip on what was happening with the 3 bedrooms, because they were above year over year by, I think, 1.5%, and they ended up falling behind almost 1.5%. So let's move on to rates. We have finally have landed on a reality where rates are over $1,000 a bedroom on average across the country. I remember when I paid $299 for a bed in college.
Not anymore.
And that was before my CA discount. So I don't when we used to be able to do discounts like that. But yeah, again, Midwest, North, and Northeast were the real big winners here as far as increasing. Southeast 3.7, Southwest 1.3, and the West was basically almost even with last year. But this kind of tells the real story. Over the past 5 years, that's almost a 28% increase. So was that like 5.6, 5.7% per year on average increase? Mm-hmm. So that's, I think that says a lot about the sector and how resilient it is, during time where we thought we were going to see a lot of folks not attend college or not go to campus, and that just wasn't the case. And then here you get kind of a breakdown of the floor plan increases. Did see the three bedrooms did see the highest at 4.1. So hey, let's start talking about this year and put the past behind us. I did pull this from the dashboard on College House last night, and it says it's through the end. It's everything through yesterday's date, 10/8/2025, and pre-lease occupancy. Again, this is nationally 15.9%, 2.1% behind year over year. And so, last month's Shop Talk, speaking with Stacy Lukoki on the same panel and at Asset Living, and she mentioned, again, this was the 11th of September. They had already rolled out leasing on half of their properties, so over 100 student properties. Even mentioned in Gainesville, she had a property that was right at or right over 60% pre-leased already. Just a question for you guys. I know you've all kicked off your pre-leasing, but are there any bright spots that you're seeing in your portfolio when it comes to leasing velocity?
Yeah, I'll start this one off. There are two markets for us that have really kicked off well: Boone and Orono, Maine. And I told this story to the group yesterday in our prep call, but we had students camping out at the University of Maine, literally camped overnight to get first position for new leasing. So there have been some bright spots. We're leasing at virtually almost every property other than a couple on the West Coast. And it's been very quick. We're pretty much in line with the national averages that you just brought up, Wes.
Yeah. It's so interesting because I feel like in the past couple of years, there was like this unspoken October 1st date was sort of like the moment when everybody had to be up off of the ground. And it just feels like every year it gets a little earlier and a little earlier and a little earlier. And there's some places where, people are moving their stuff up the stairs for move-in, and we're asking them to renew at the exact same time. And so I think there's a big conversation around like, what is the ideal moment, right? Like, is there a such thing as leasing too early? And I think in some key places, I think you're kind of better off having your traditional welcome weeks and your customer experience moments before you really hit the ground running, and you give yourself the benefit of that experiential moment to have a more successful lease launch. And then there are some markets, for us, Austin is a big one, is it just, as it always has been, it just kind of lights on fire from the moment people walk into the door. I think Mizzou was a good one for us this go around for potential lease launches. I don't think I have people lining up the door, Brian, so you're going to have to teach me your tricks on that one. I haven't gotten to the Best Buy moments where they're waiting for the iPhone outside just yet, but those dates did exist, and it is an interesting dynamic that if you play your cards right, I think we could kind of get back there on really being more intentional on timing and not just automatically assuming that earlier means better, because I think there's some balance there.
Yeah. I'm going to echo what Christina said, and we were talking about this yesterday about, finding the sweet spot of launching too soon versus launching too late. And one that is really going well for us is West Campus. We're really outpacing ourselves in Austin, and it's funny because it's a site that, we typically struggle quite a bit with. And I think we've kind of finally found that sweet spot with the rate, on top of going all inclusive, kind of condensing our floor plans, removing some of those premiums and baking them into the rate. I think it's been a learning lesson year over year, but we are finding in multiple markets, in most of our markets, honestly, that presenting prospects with a more digestible rate has been the way to go. Whereas for years and years, we had the ability to come out the gate with these strong rates and then a premium for essentially every floor, which window they faced in West Campus, if they had a room with a window at all. And we've kind of really had to take a step back and condense some of that. This was a market where prospects were kind of coming to the office and bartering with us and saying, okay, well, what are you going to give me? What rate are you going to give me? And we finally kind of took a step back and said, you know what, right, like here it is. And again, we're just outpacing ourselves by a lot this year. And I think it's finally at a point where I would say it's stable, which is not something we've experienced years prior.
So I'll throw my next question up here. In what I do, I talk to a lot of regional managers and asset managers and site managers. And the one thing I've heard consistently since, about June of folks that were trying to get things ready for pre-leasing, setting their tiers, that this caused a lot of frustration for them. Seemed to be not necessarily unknown, but this, kind of this whole thing of, hey, we've had some really good years and we can't continue, pushing things, or should we continue pushing things? It'd be great if all the universities kind of gave their enrollment projections as applications were coming,
Right.
but that's really hard to do. So how was the rate setting process compared to previous cycles for you guys? And are you seeing any pushback from prospects and renewals with the early numbers you guys have put in front of them?
I think for us, this year's rate setting process, I feel like it's becoming like an art and a science for how you decide to go about this. But I think it was much more of a year of self-reflection on maybe comparing ourselves to as our own worst enemy of what we did right, what we did wrong. I think sometimes, you immediately go to historicals of where do you think the comps are going to come out at and where are you going to line up against those individuals. And I think especially in the areas where there's new development coming and you're kind of in a top tier market and you're a Class A asset and you're wondering like, how does this affect me? And I think the general stance was maybe it's less about what everybody else is doing and more about how are we going to handle this ourselves in our generalized approach with the demographic that lives there now and the people that you'll be handing renewal offers to. So I think for me, the onion kind of peeled back less about everybody else and more about ourselves and our own performance. And I think that's kind of what we're going to have to hold true to as we continue to progress throughout the leasing season.
Yeah, I echo that as well. I think that's the challenge though, right? This is the first year that we have done the leasing so much in the dark compared to prior years where we kind of knew where everyone else was coming in terms of pricing. So that has been interesting to try to hit a target with a blindfold on, so to speak. I will say, our renewals have needed to be a lot closer to flat in many markets, and the tier is not quite as strong as in the past. And then we are getting a little pushback in terms of timing in certain markets that they're not ready to make decisions as early as they have, kind of what we already alluded to. But it is market specific. But I think some folks are learning that they can wait and still get decent deals or specials toward the end of the leasing cycle. So,
yeah, it sounds like we're all having the same experience because for us, like Christina said, the rate setting process was extremely meticulous. We kind of took more time than ever. We did more research than ever. It almost felt like we were setting kind of custom renewal offers per resident. And much like Brian, most of our renewal rates are where we fell flat and trying to grow that rate in the new lease tiers. And just like I mentioned earlier, kind of removing some of those premiums, baking some of those things into the rate, maybe going all inclusive if it's a market that's super price sensitive. So It's been what Christina said, it's been an art this year.
Yeah, I think the last thing I would say to put up the cherry on top for us was we also had to build out enough of a model that we gave ourselves the grace to be able to be flexible in that if this is not the right plan, you have to be able to give yourself enough of a buffer that you can be nimble and you can pivot without the whole plan falling apart, right? Just because one domino falls doesn't mean they all have to. And I think that was sort of a conscious effort we made kind of walking into it.
Yeah.
All right. So guys, in the interest of time, I've got 3 more questions. So I'm just going to ask if you've got something that, is maybe different from what everybody else has said. Not that you guys are saying the same thing, but just in the interest of time, I want to go through it. Maybe we'll just do one response to each of these questions. But I wanted to ask this question. I want to bring up, let me share my screen here really quick too. And we're still another couple weeks away before universities start submitting their common data set. And, but we are getting, at least in the media, we're getting some early numbers, especially if they're good. A couple of headlines here. University of Kentucky celebrates record enrollment milestones for fall 2025. I think Brian, you mentioned University of Louisville as well. University of Illinois announces a record enrollment largest freshman class. I think it was maybe just under 10,000. I know it was definitely a strong 9,000 number. And then I've got another one. I'll have to bring it back up, but because I think it's behind a paywall and I didn't log in. But there was another one for University of Arizona, a 20% decrease in freshman enrollment. So my question to you guys is, have early enrollment numbers cause you to rethink your pricing or marketing strategy at all?
Yeah, I'll take this one really quickly. Not entirely. The enrollment numbers obviously come in after our leasing's kicked off in most markets. But that being said, as we experience those velocity challenges and the enrollment numbers come back in, if we couple that with those enrollment concerns, we'll just adjust our strategies. You know, as folks were saying, we just need to be nimble. We need to adjust those rate tiers accordingly.
Great. Anybody got anything else to add to that? Cool. So something that came out of our prelim call yesterday that I definitely wanted to expand upon and ask you guys a little bit more about, but you mentioned this whole thing about students are seeming to kind of organize themselves into large groups. And at first you said they're coming in as large groups. I thought, okay, you're talking about fraternities, sororities, club sports, whatever. But you said no, they're really like almost unionizing themselves to some degree to come in and negotiate lease terms, which I found incredibly insightful. And so any insight on how they are organizing, and is it just a rates thing that they're trying to negotiate, or is it, are they wanting, to be in a particular building on a particular floor? Give us a little bit of insight on that.
Yeah. I'll let Christina take this one because I think
I was just going to say it surprised me as much as it surprised anybody else, because I think there are specific markets where it literally goes into our rate planning strategy, because we know every year that these groups are tending to get together. And you're right, they're not clubs on campus. They're not Greeks. They're just students that are starting to have, as the largest group we signed so far this year was like 20 people. And it's just because they all kind of knew each other. I will say their expectations very much are that we're going to cut them a deal on rate. And it is less about placements in buildings and things of that nature. But I'll tell you, the timing also very much surprised me, is because if you do see these groups, I mean, it was happening at the beginning of September, right after move-in. And I don't think that I was used to Greek organizations moving forward, but it seems that in specific markets, this isn't the first year. It's just starting to pick up a bigger trend, because they're learning from each other that, if I can go greet a group of 10, 15, 20, all of a sudden there's a financial impact to it. So I don't know, Sydney, if you're seeing the same thing.
Yeah, I mean, exactly that. I think I have industry peers who have seen massive groups, but from like my experience, and really market specific, but they are coming in in groups of 15 and 20s. And I think we have the opportunity to capitalize on that. Like Christina said, they're building it into their rate plan. And, just as we were talking about yesterday, I don't think we give the renter enough credit. They're learning from each other. They're learning from their upperclassmen. They know our tricks. And I think if we just acknowledge that and work with them, we can make this mutually beneficial. They want a solid, rate plan. They want a solid incentive, and we want to fill our beds as quickly as possible. So I think if we work with them, I think we'll see that this incentive plan can work.
Well, great. So I'll get to my last question here. Are there things that you took note of last year, during this lease up cycle, that have caused you to change how you're spending your marketing dollars this year? I've heard for, kind of the first time, some folks talking about programmatic marketing that they're doing on Hulu, and, a couple, maybe paying a little bit more attention to TikTok, that kind of thing. Were there any things that you took note of that, now you've put into the marketing plan for this year, or maybe decided to spend more or spend less in something?
Yeah, I think for me specifically, when we were talking about marketing budgets, I kind of went back to some basics, right? Like, how much are you spending on things like ILSs? And are we peeling back those specific data-driven decisions on what type of leads are we getting? What are the conversion ratios? What is the accuracy of the data that we have ourselves and that we're comparing to make sure that there's some validity in those decisions? And I think that was a big part. And then even something as simple as like some basic 101 boots on the ground, like, how much money are we putting into promotional products? Like, is a t-shirt and a cup on campus and bar marketing, are we really kind of getting out of it what we thought we were going to be? And I know we've been talking about that for a couple of years, even post-COVID. It was the hot trend for a little while, but I still see it pop up in marketing budgets all the time, is, okay, well, let's just kind of get something more tangible. And that seems to be like this preconceived notion that it'll turn into a contract. And I still think there's some room in that discussion of, I don't know, what on-campus efforts in handing out promo, what do those really come to? And I think tightening the belt on that maybe a little bit is the direction that we started to go in.
Great. Sid or Brian, you guys have anything?
Nothing to add.
No.
Well, guys, I appreciate it so much. You've been a fantastic panel. I know I've talked to you about being at LeaseCon, TurnCon this year, and I hope you guys will all be there. There's some incredible insight that I've learned from you guys just in the past week that I think everybody would definitely benefit from. And it's a discussion that as we get through on the other side of Thanksgiving, I think we're going to have a lot of things to talk about, especially if that number continues to look, more like 2018 and 2019 for pre-leasing velocity than anything else. But thank you so much for your time, and we will see you soon.
Awesome. Thank you for having us.
Great. Well, guys, our next Shop Talk is going to be Thursday, November 13th at 1 p.m. We try to do these on the second Thursday of each month. So you can definitely find out when those are happening by going to our events page on our website at studenthousinginsight.com. You can also review this Shop Talk as well as previous Shop Talks that we've done by going to shoptalk.info. Looks like you can scan that QR code up there as well. Thank you, Jan, for adding that. But that's what we'll be doing on November 13th. So thank you guys so much for tuning in for this one. If we've added any value, please share this with your colleagues. Again, you can send them to shoptalk.info. We will see you next month.